They decipher the Rubik's Cube of underwriting and lending and process, and they connect the thousands of dots needed to actually facilitate a loan in this very challenging underwriting and operations climate. We have an amazing person who is the director of all of our operations. I've known him for many years. He is one of the smartest guys I know, and also one of the best people I know. And I appreciate if you help me welcome Mr. Patrick Palmer, Vice President of Operations.
Thanks, Ed. I don't remember being called a good human being before, so that's a good start to my day. I was asked to stand over here because they're videotaping me, which makes me a little nervous, and I'm going to say something I get paid to. So if you can't see me in the back, just consider yourself lucky. What I wanted to do today is a couple different things. You can imagine being asked to talk about a topic like underwriting, and the first thing that went through my head is, how do I keep people awake, for a couple of minutes? But it dawned on me that there's probably two sides of this. The side that you guys see, which is probably what the consumer is going through, your client, the one you're representing, no matter which side of the transaction you're on. And then there's also the underwriter side. And so hopefully I can give you a little bit of a peek into both. And so what I did first is it's been a long time since I've been an originator. I started the business as an originator, then I moved into operations. So in operations, I oversee underwriting, docs, funding, through the loan close and purchase with the investor. If it doesn't go right with them, they send the loan back to me and then I get to work on it again. So you guys have moved on, the originators have moved on, but if it doesn't go well, it comes back to our desk and we get to kind of sort through and restructure after the fact, which makes it very difficult. So I looked up this letter from the consumer side of things, and it dawned on me what they're going through. So I found out maybe I'm a little too far removed from the consumer, and it would be good for me to read this. And I know why we do all these things. We take all these steps. We ask for all these documents. We put clients through probably a miserable 20-day or 25-day period, like you guys said. But this letter really kind of struck it home for me. So there's a little humor in here, and hopefully it'll make it light. So this consumer was writing this to the originator. To whom it may concern, after 9 weeks of many phone calls, I'm writing this letter to discuss a few items that the underwriter has not yet brought up, or probably will. I am not now, nor have I ever been, a member of the Communist Party. Neither my parents nor my grandparents were ever members of the Communist Party. I was born 7 months after my parents were married. I hope this doesn't qualify me for the mortgage. I'll have my mother and father send you a letter explaining how that happened if it's necessary. I'm not a bedwetter or a thumbsucker. I have no religious affiliation. If this is a problem, I'll get a letter from a priest, minister, or rabbi stating they'll let me join up if you feel it's necessary. I want to apologize for the $36,000 in the bank account that I reported having only $8,000. I guess if the underwriter finds out I have $100,000 spread out in other banks and investments, I'll never get a mortgage. I also want to apologize for only putting $55,000 down on a $115,000 purchase price. But I'm really concerned because my wife and I are only earning $78,000 this year. If you decide this is not enough, I'll be happy to take a part-time job at night at Roy Rogers. I'll have the manager at Roy Rogers send you a letter if you feel it's necessary. I'm a registered Republican. I know this may not sit well with underwriters who are all Democrats. My only defense for this is that anytime you see a man driving a Jaguar, wearing a $600 suit, a $165 pair of loafers, a $70 custom-made shirt, a $2,000 diamond pinky ring, a $750 Cartier watch, a $265 cigarette case, and a $400 attaché case, he's either a Republican or a dope dealer. I'm not a dope dealer, and I'll send you a letter stating as such until it's necessary. There are three things that concern me. When you buy a mattress, there's a label that says, "Do not remove under the penalty or fine of imprisonment." I'm sorry, it was rash. An impulsive thing for me to do, but I was a kid at the time. I promise I'll never do it again. In February of 1934, my grandmother missed a payment to Sears. She's dead, but I'll have the undertaker send you a letter explaining why she can't send you a letter explaining her dependency. On April 14th in 1968, I got a traffic ticket. I'll certainly send a letter on this one. However, the real problem is that the police officer who issued the summons is divorced. I've requested a copy of his divorce decree and separation agreement. I hope this one survives. I want to thank the receptionist, the person who took my original loan application, the underwriting staff, your appraisal department, the manager of your branch, the president of your company for granting me this loan. God willing, we will make it to the settlement table and realize the American dream of living in our house. You guys feel that for your clients? misunderstood creatures called underwriters, because I work with them every day, so I kind of get their quirks and I know who they are, and I was like, all right, because I'm not a technical underwriter by trade. So if you ask me a guideline or you ask me something really specific, I know credit policy and risk mitigation, but I'm not going to know every single detail there is to know about underwriting. So I said, give me 5 things. And these things are going to be so simple to you, but these things have been going on since I was an originator. So I'm going to bring these up quickly, and then we'll breeze through the rest so that we can get through these. So we're often called by our originators and others the loan prevention department, which you probably heard that joke before, but we're really not. The underwriters that I work with on a daily basis, they know how important it is for loans to fund, because like any other company, we have huge ups and downs in the mortgage business, just like you guys have. Most of them have been laid off during their life. It's not a welcoming thought to try to figure out how to find a job in a down market if you're an underwriter. So they actually work very hard to structure deals, and although they make it maybe a little bit more painful than it should be at times, we try to help them with that. That's definitely not our goal. Essentially, these folks are given a set of rules or guidelines that they have to follow in order for the loan to sell. Very, very few lenders, and we'll talk about portfolio lending, we'll kind of touch on it, but that's a really minuscule part of the business. Most loans are funded, they're sold to an investor, they're sold directly to an agency, or they're sold to a Wall Street conduit who makes it into a security. So they have rules, and these rules vary for every single investor. So imagine you get a loan and it's structured, and now you have, let's say, 20 different investors, the agencies, or Wall Street, and you have to figure out how to sift through all those guidelines and make it fit so it can sell. If the loan doesn't sell, you know that it's coming back on your desk. And that's a very daunting thing for them because they don't want to deal with it after the fact. A lot of times that means that they have to call your borrower. Think of the misery of us going to the loan agent and saying, hey, I need you to get an extra pay stub, and I know they've been in the house for 2 months, because these things don't happen for about 30 or 60 days. The majority of the underwriters actually really take joy in seeing a loan fund. They hate to work on a loan for hours and hours on end and then not see it fund. So I think one of the many misnomers is that they're really trying to stomp a loan out and prevent it from going through. It's actually, in my experience, 18 years of working with underwriters and managing them, they really work very hard to try to make a loan go. You have a few of them, there'll be some percentage that actually dig in their heels a little bit. And I heard somebody say, there's a lot of appraisal talk in here this morning, which was really good. But underwriting, because about 50% of the guidelines they follow are very gray and open. In fact, sometimes the guidelines will say, refer to agency. I mean, that's it. So they have to make a call. And so for them, it can be a little bit logic. The other 50% of the guidelines are just hard and fast. There's a true box, and they have to try to stuff it in that box to make it work. And so for them, there's an art of, how do I make this look? How do I frame it? How do I put it together so that when an investor looks at it after it's funded, that they'll purchase it and believe that the loan is going to perform. It's all about performance. So when you talked about appraisals earlier, I thought about this, because this is true of underwriters too. They get stuck in old ways. So if you remember when the market started going down to the tune of about 30% nationwide, the appraisers really struggled in a declining market. Well, underwriting, now that the market's going up, I'm hearing they're struggling with the same things, right? So they're struggling with, how do I value this property from a comparable standpoint? Which, you're right, I mean, the economic valuation of a property is what a buyer is willing to pay and what a seller is willing to sell for. That's the true market value, I mean, in economic language. But we got to support it. And so sometimes they get stuck in old ways. I'll find them wanting to do something that's 10 years old that we don't need anymore, which could make the transaction easier. So we try to get them to think, all right, here's what's happening. Unfortunately, the business goes, let's reduce all the documentation to nothing. Let's not ask them for anything, which makes them scratch their head. Well, how do we know it's going to perform? And then we turn around and we say, well, now we need you to get everything plus then some, just like the letter you witnessed. So these are the things that they came up with. And I don't have any solutions for these, but I want to tell you, these are the things from actual underwriters that they say, when we work on deals and we get to the end of the transaction, this is the most frustrating thing that happens to us, that either kills the deal, blows a lock, blows an escrow, close an escrow date, and they've been around for a long time. So any change in terms of the purchase and sale agreement actually can create a dead deal for us. Due to the appraisal independence rules, how many of you guys are familiar with HVCC? Did Gary come and talk to you guys? Yeah. So error basically took place at HVCC. So for us as originators or underwriters or doctorars, we can't talk to the appraiser at all. And as I understand it, I'm not a licensed realtor, but as I understand it, you guys can talk to them until it's been completed, correct? So you can talk to the appraiser until it's been completed, I believe. So if the price goes up or the price moves or something's added to it, for us, we can't go to the appraiser and try to fix it at that point in time. And if it's past the point when they've turned it in, we can't really go to you, so now we have to go to the appraisal management company, and it creates these huge delays. So if there's a change, anything that you can communicate to the originator that you're working with and get it sent over as quickly as possible, we always find things get lost. It's maybe almost good to just double check and say, hey, did you get this? Because there's a change, and this change could possibly kill the deal, because if the appraisal doesn't come in, again, then you're talking about coming up with a difference in funds, et cetera, et cetera. Adding personal property to the sale without adding a term of no value given or increasing the purchase price. Maybe none of you do that, but when we're looking at it at a very broad scale, the investors are not created equal. And so when they look at personal property, it's not part of the deal for them. So if the purchase price goes up, what ends up happening in this deal is it doesn't necessarily kill the deal, but we got to go back and usually rewrite a bunch of verbiage and language and make it acceptable to the investors. Because for them, personal property can be removed from the property, and it depletes from the collateral. So that was the second one. Inspections can possibly lead to repairs, which can possibly lead to appraisal and underwriter review. So for you guys, I don't know your rules and your laws, so I won't pretend to. I'll let you guys speak about that. You did a great job this morning of going through your forms and saying protect yourself this way. But the one thing that I've noticed is that when we list out, or when we see the repairs actually listed out on the earnest money agreement, whether they got completed to the liking of the buyer or the seller, the underwriter will automatically have to check each one of those off. We'll have to order the 442 addendum from the appraisal. They'll have to go out and they'll have to check these things off one by one. So a lot of times the underwriters tell me, we would prefer it if it just came back and said, all these contingencies have been met, the repairs are done, and we're complete, and thank you. But when they're listed out, and that may be to protect your client, I'm just telling you from the underwriter side, that's when they have to dig in and start getting the appraiser involved. And this, again, is what creates kind of a time suck for them at the end. Yeah?
Are you asking, we have a lot of addendums that we put on our forms. So now a lot of lenders are starting to ask for all these forms, that seller transfer disclosure, the seller questionnaire, the blah, blah, and the blah, blah. So are you doing that? Is that the new norm, where you have to get a copy of everything on the purchase agreement, everything that's referenced on the purchase agreement?
As far as I know, not right now, but that doesn't mean that it's not coming. So in terms of the inspections and repairs piece, this is just something that's gone on for a long time. And so I'm going to talk about the changes in desktop underwriting, and probably a lot of you are just starting to feel the changes in desktop underwriting right now. A new version rolled out, so I'm going to talk to that. So we'll talk about the loan conditions that are going to be added, but for us, not yet. But it doesn't mean that it's not coming, or we're not starting to see it from investors. So purchase and sale, and this is relating to signatures. So we get this, hey, it's not legible, I can't read it, so I give you another copy. So we send a copy of a copy, then we still can't read it. So it's acceptable for us if you send a copy of the original agreement without signatures, so it's the fresh, clean agreement, and then you follow up with a copy that has the signatures. And some of you, again, maybe you're already doing that. But these are the things that they found that when I'm underwriting a deal from the real estate side, these are the things that slow us down. So anywhere we get help there is going to help your client and help the originator. So I'm going to jump to Fannie real quick, because I want to get to the end, and I will take as many questions as I can. But in their new release, see if I can do this. This little statement in here is a little change in thinking for Fannie Mae. Most of you know that Fannie Mae and Freddie Mac are trying to be pushed together. They're the biggest issue of securities right now. This first quarter for us at RPM was the first time we funded more than 20% of our business in actual jumbo business that went to Wall Street conduits. It was 40% of our business. So the majority of the last years has all been Fannie, Freddie, and Ginnie. So their mission is to help eligible borrowers access mortgage credit to purchase homes they can afford over the long term. So their underwriting criteria in their software, they started changing their logic. And when I moved a little deeper, this version 9.0, which came out in October but really didn't get funneled into the system until January, had some additional verbiage, is that they used to write all their logic around default. They have all this data in their database, and they know, with some statistical evidence, what defaults when we put it in the system and what doesn't. Now they're moving to what's going to be delinquent. So what's going to be 30, 60, 90 days delinquent. Because of the new foreclosure laws, fewer and fewer lenders are foreclosing because it's so difficult, so onerous, and they tend to get sued a lot. Look at Chase, they'll tell you all the time, we don't necessarily want to be in the mortgage space, but we're here to serve this broader base of our banking core business. So this was a change for us. We didn't really have an understanding of what it would mean, but we do now. We've had several months. So this is what you're seeing, and here's why. In their data, essentially self-employed borrowers, which you probably have a lot down here, you have a lot of K1s, you have a lot of corporate returns, you're going to be asked for a lot of new schedules. If you haven't already seen it, be prepared. They're asking for all schedules of all returns. And so when they run their loan through Desktop Underwriter, which gives us kind of this approval, it's a framework to go by. It's not necessarily an approval, but it's a framework to go by. We used to just be able to get the 1040s in your W-2 and your pay stub and call it a day. Now they're also asking us for all pages of corporate tax returns. So if you send the initial tax returns and you see that there's 2 K1s, now they're going to ask for the entire partnership return. So we're adding more paperwork as we go along. They've also asked us for manual calculation of assets. So what does that mean to you guys? Well, they're getting a lot more serious about these large deposits. And I think the bank account statement, the story from the client is really relevant because we run into this all the time. If we have a client who has a large deposit on their bank account, it can literally kill the deal for us. And the reason we track it down, most of you probably already know, but we want to know where the money comes from because it could create another source of debt, which creates a payment, which could throw off their debt ratio. And so we paper trail all these things as a matter of protecting the investor. And so now they're asking us to actually sit down and manually calculate where all these assets are, how they're stated, where they came from, and put it in a document and load it into a file. Whereas before we could just look at the bank statement and say, you've got money in there, I don't see any $50,000 deposits, so we're good and we're moving on. So they're now asking us to kind of continue to take more and more steps. So you're seeing these as added conditions. We have a kickoff party every January, and I had like 20 originators come to me, and I hadn't seen some of the new conditions that were going on the underwriting approvals. They literally asked me, do you guys have a change in underwriting philosophy? So I had to go digging and try to figure out. I was like, no, we haven't told our underwriters to do anything different. So what you're seeing is essentially Fannie Mae continuing to ratchet down when we would hope that credit is loosening and that liquidity is returning to the market. They're still kind of cranking down on certain areas. So I also got asked a question, and I know I'm moving through here quickly, but depository banks and mortgage banks, what's the difference? Why does the approval look different? And just run through these points real quickly. It's just really a matter of liquidity. I think probably most people know that there's a difference between holding the actual mortgage asset and retaining the servicing. And retaining the servicing means we sell the loan, it goes into a security and it's sold to a bondholder who clips a coupon like they would on any regular bond. But we retain the rights to service the mortgage payments, and we get paid a fee for that annually. There's also a job to do there, and that's if something goes bad, you get to chase it down. So there's pros and cons. There's also no fee for selling the loan. So if you decide to keep the loan in its mortgage servicing rights, you're basically collecting the fee over time. What this allows you to do is this allows you to sell directly to Fannie or Freddie and forego the big bank investors or the REITs, which layer in their own credit risk models. A lot of you guys have probably heard the term, well, there's an overlay. And that's typically because it's going to a Chase or a Wells or a Citi, or it's being sold to some big bank aggregator. And so to avoid those overlays, we tend to want to sell it directly to Fannie Mae, so we just have to follow their guidelines, follow their desktop underwriter, and then collect the payments. We talked about portfolio lending. This is true balance sheet lending. So if I got a big bank and they've got a big balance sheet, most of the time that you see this is with your community banks or commercial banks, and so they have a very, very low cost of funds. They can borrow money on the cheap, and if they can do a deal for 5.5% or 6%, they take the spread, but they tie up that money. There's no liquidity. So for most companies, even the big banks, Chase, Wells, Citi, they all do the same thing. They all sell their paper to Fannie and Freddie. They just keep the servicing. And to make this make sense up here, it's got to be probably north of $5 or $6 billion. So you got to aggregate quite a bit of paper for it to really pencil for you. And then this is the one that I think probably makes the biggest difference. I worked for a bank when I was first in the business, and we had certain cross-selling metrics that we had to meet the President's Club. So you might ask, if I'm working with ABC Mortgage, who's a mortgage banker, they don't have a depository arm, and I'm working with Chase. And on one particular deal, Chase has no conditions, and they get this deal done really quickly, and you've conditioned the heck out of me. What's the difference? And then the next time I went to Chase or Wells, I'm just using them as an example because they're the big banks everybody knows. I went there and I couldn't get anything done, and it got stuck for 90 days, and it killed my deal. So why the difference between these three? So if you listen to Jamie Dimon at all in the last probably 3 or 4 years, he's been preaching that he doesn't like the mortgage business all that much, but he does it because his core banking clients need that product. So they can cross-sell. Think about a loan application, right? What does it have on it? It has your income, it has your assets, it has all your schedule of real estate, it has everything that you need to sell somebody credit cards, lines of credit, checking accounts, big corporate depository accounts. And so that's the difference. They'll take a gamble or a flyer a lot of times on clients who are high net worth, who have a lot of assets with them. And that's an area where sometimes we just sit back and we say, hey, we can't compete. If the big bank who has all your assets is going to give you 2 3/4%, and they're not going to condition you for anything because you have all these other accounts that they're making money on, that's where the big banks have a competitive advantage. There's also a time when they don't necessarily see those clients, and the mortgage becomes kind of a backseat product for them, so it takes forever. Whereas, for the mortgage bankers, people who don't have depository banks, it's their only line of business. So when you're seeing a difference, realize that no two clients are made the same, and banks and mortgage banks will make their decisions based upon a lot of different varying factors, and they may be willing to say, I'll take the risk on this client because I want to have an opportunity to sell them all the other things that come along with it. So I think the last thing that I have is delegation. And delegation is just your ability or your authority to underwrite your own loans. So again, no mortgage bank or no bank is created equal. So these are some things that if you're working with a lender, you may want to ask. So the agency and typically the investors are the easiest form of delegation to get because it's the lowest amount of net worth, and they'll let you underwrite the loan and you sign off on it and you can fund it. You don't have to ask their permission. The next one up from that is being direct with Fannie, Ginnie, being a direct endorsed lender so you can do FHA loans directly, being a VA lender direct so you can do VA loans directly. Those are harder because you got to go through the government scrutiny. So you have to have a higher net worth, you got to go through the government scrutiny. The most difficult are the conduits, or basically what are the Wall Street firms or REITs. So anybody who's doing something that's above the conforming high balance limit, which down here is probably 625, or the 417 loan limit. This is the hardest to obtain because they want sky high net worth. They want you to kind of co-deposit a bunch of money with them. So if you're going to underwrite these big jumbo deals and you're not going to have anybody else look at it and sign off on it, the constraints to get this done are really, really tight. And the one thing that I would probably ask is, are you guys delegated? If you're doing a lot of big loans, I've heard a lot of big prices in here. I'm from Oregon, I'm from Lake Oswego. So our average loan amount is $228,000, our average purchase price is about $400,000. And if you sold $1 million property in Lake Oswego, it would be like a 6,000 square foot mansion on the lake, right? So, I mean on the lake, but in Lake Oswego. So in this market, you guys probably need access to that money. And this is what tends to happen, is that people will say, hey, we're delegated, when really they're going to a due diligence firm. So there are companies like Allen Hill, Clayton, those sort of people. So they'll sign off on the loan as a lender, then they'll ship it to a due diligence firm who will add more conditions, then they'll sign off on it, then they'll review it and sell it back to the Wall Street conduits. So make sure that when you're looking at who's going to be doing this lending and how long will it take, you can kind of judge the conditions or how long the deal might take by understanding how they're delegated, what their delegated amounts are. So these are good questions for you guys to have with your referral planners. Are you still awake? So I wanted to finish with, hopefully that gave you a good broad overview, and you're welcome to take as much punishment from here, but I wanted to finish with this because I wanted the underwriters to have a little side of it too. So A man in a hot air balloon realized he was lost. He reduced his altitude and spotted a woman below. He descended a bit more and shouted, "Excuse me, can you help me?" "I promised a friend I would meet him in an hour, but I don't know where I am." The woman below replied, "You're in a hot air balloon hovering approximately 30 feet above the ground. You're between 40 and 41 degrees north of latitude and 59 and 60 degrees west of longitude." "You must be an underwriter," said the balloonist. "I am," replied the woman. "How did you know?" Well, answered the balloonist, "Everything you told me is technically correct, but I have no idea what to make of your information. In fact, I'm still lost. Frankly, you've not been much help so far." The woman below responded, "You must be a loan agent." "I am," replied the balloonist. "How did you know?" "Well," said the woman, "you don't know where you are or where you're going. You made a promise which you cannot keep, and you expect someone else to fix it. The fact is, you're in the exact same position you were, but somehow now it's my fault." We can talk about turn times or anything else, but cut me off or shut me down or shoot me out, but whatever you guys want to do, I'm on your time.
Is this question?
Sure, absolutely.
Okay. You said change in terms can cause a problem. So what's considered a change in terms? I mean, what if they decide to put more money down or less money down, or they're reducing the price, or?
Did you raise your hand?
I'll just answer one piece of that, Angel. One of the things that slows us down as originators through the process, and this happens, it's life in our business. You'll get a last-minute request for a credit for $5,000 worth of closing costs, and you bring it in. You're 5, 6, 7 days ready before closing. We're getting ready to order the loan docs. You send in the credit request. Doesn't sound like a big deal. It ends up being a big deal for a lot of the reasons that Patrick mentioned. It has to go back to the underwriter, has to be signed off, and then it has to go back to the appraisal department for them to okay that it didn't affect the value of the property. It's typically not a problem. You'll get it done, but be prepared. If you're going to come in with those last-minute credits, you can probably slow down. You're probably going to delay your escrow a little bit.
Okay, so what's last minute to you? When do you need to get it done?
If you're asking loan originators, I'd say try to do it at least a week before you're ready to close.
7 to 10 days would be prudent, because what happens also is that we have all these APR calculations that we have to go through, and credits, depending upon where they're slotted, can affect the APR. And we're so beholden to these time frames for putting out our disclosures that if we don't have enough time and we end up having to send out what's called a change in circumstance, that's where we end up having a lot of problems. So the majority of them are changes to the actual purchase price, where it goes above, the appraisal is in, now it's above. The second thing would be credits up and down, and then adding anything to the purchase and sale agreement that you're throwing in, which alters the price.
Yeah, I would suggest to everybody, if you're even thinking of putting a credit into escrow, just put it on the lender's radar, whoever you're working with, even if it's not concrete. Because that way, if the docs are already drawn, it's one set of systems, and sometimes if you can catch it before the docs go out, it's a little less of an invasive process. So if you're working on a deal, and obviously you have your party to certain details of the transaction that the lender never sees, but if you're looking for a repair for credit for repairs or whatnot, definitely at least put it on the lender's radar so they know that there may be a credit coming, so that way they can help you plan your timeline accordingly depending on how quick your close is.
When do you determine who the loan is going to be sold to? Right at the beginning, or?
In our company, it's actually wide open to the originator. So they actually will go in and they'll price the loan, and they'll be able to pick the investor based upon the client's circumstances. But every company is different. Some company they have just a box, and so they take kind of the lowest common denominator from every investor, and they circle them in and put them into guidelines. Banks that they write their own guidelines. So it really just depends upon what company you're working with. There's also different channels. So you have bankers and brokers. Brokers will kind of pick, maybe based upon price or product. So then they're beholden to the underwriting of the company that they're, third party originating to or brokering to. So it all depends. But in our system, we pick the investor from the get-go. And I think it allows the originators to see what's best for the client and say, okay, I know if I take it over here, they're going to be, there's going to be 35 conditions. If I take it over here, there may be less of a credit available to them on price, but it will allow us to forego some of those conditions. So our originators pick it up front.
What's the largest amount of credit you can have in a transaction, percentage-wise?
Largest amount of credit in terms of the...
Like from the seller to the buyer, whether for like, instead of repairs, it was a credit for those repairs.
So it goes by LTV, but it's 6% is the cap for the most part, and as you get into higher LTVs and some of the other products, will limit you to 3%. So it depends upon the product, but the majority of it is a 6% cap with the credit.
What about rent backs? You hate them, all good for 30 days, things happen at the end of escrow. And so some lenders don't like them, I've heard.
Yeah, rent backs, as long as they're written up in the agreement, to us are no big deal. I mean, we have a much bigger problem. The bigger problems that we have when something kind of happens at the end, there's some sort of repair and it's sizable, and so when we get asked to do an escrow holdback, that's different. But when somebody's just staying in the house and they're renting it back, it may create some additional documentation for it, like a lease agreement or something to that effect. But from a credit standpoint, it doesn't affect us.
Is there a time limit on how long they can rent back for?
Yeah, I mean, when you start pushing out 90 days, then they're going to start to really probably look at it and go, okay, what's the situation here? And as you get further past that, they're really going to frown on it if you start talking about 6 months. Yeah.
I've had some escrows where my clients are pre-approved, they have a pre-approved letter from the lender. Yet when we start processing the loan to the underwriter, suddenly they need many more documents. So now all of a sudden they need a third-year tax return, they need this and they need that. So it ends up delaying escrow sometimes. I don't understand why they aren't asking for all that up front so that there aren't delays later on.
That's a great question, actually. I just call it the proverbial can of worms. So what happens is they submit the loan with all the documentation after they've run this automated underwriting system for the most part. That's the majority of our loans. So the automated system will ask us for 2 years tax returns. And when we get into it, we'll find something in the tax returns that we need more information on. Sometimes it's continuance of a specific type of income. And we find out that the investor says, well, we need continuance for 3 years, or we need a 2-year history, and let's say we only had 1 year's tax returns. So there are a lot of different occasions where an underwriter gets into it, and the base documentation that we needed according to this automated underwriting piece is fine, but all of a sudden when you start unearthing it, it's just like an appraisal. If you get into an appraisal and there's cost to cure, you think you're good to go, the appraisal's done, and the value came in, and you're going, yeah, but then you get into it, you open up this can of worms, and all of a sudden now you have all these other things to work on. And that's the majority of what you're seeing, is that the original set of documentation that's submitted gets reviewed and analyzed, and it kicks off a bunch of other questions that we have to meet to suffice the investors.
One challenge that seems to come up now and then is an underwriter that sends back sequential requests for sort of one additional item at a time. Now, granted, a lot of times that's more on a short sale or something, but in the case of a traditional loan, well, we need this tax return now, great. And now we need this, now we need bank statement, great. Now we need this, and you kind of sense that they really, if they'd taken their time, could have given you a whole list, as opposed to having things stretch out over, it could be multiple weeks with sort of one request at a time.
I think that's great. Again, not all underwriters are created equal. So these are all things that I'll take back and talk to our underwriters about. It's like, hey, you can really help the lending community and the real estate community by trying to compress these things into one. And sometimes they don't have all the data in front of them. So they get one piece back in, and then that creates the questioner need for another, right? And then that creates a questioner need for another. And that's what we see more often. I think their intent is truly, they would love to stamp it the first time it comes through, because a lot of them have metrics to meet. So a lot of these underwriters have to get through X number of files per day. But you're right, sometimes you got to slow down to go faster. And again, each deal having a different set of guidelines. Sometimes what will happen is that we'll get halfway through a deal and we'll find out it doesn't meet that particular investor. So in order to save the deal, we'll switch it and go somewhere else, which kicks off a different set of conditions. And so they may not be eligible for one product. We try to counter or restructure the deal to make the deal happen. And it ends up triggering a bunch of additional conditions. So that may be what you're seeing as well. Guidelines are changing so quickly for us that it's really hard for them to keep up sometimes. And sometimes I'll be honest, they just flat out miss it. So a bulletin comes out or something comes out, and imagine if you have a dashboard of 15 or 20 different lenders with 100 products, if you miss one bulletin on that 3-year arm, it can, you know, really mess up an entire deal. So sometimes they're human and they just flat out miss it.
Is there such a thing as a commitment letter in your world? Is that really so 15 years ago?
Yeah, I mean, I think what you're seeing right now is still people largely operating out of fear. I mean, in the mortgage industry in 2007, when everybody just shut the faucet off of money, which is how we survive, now they always have that in their head. So I think you get a commitment letter with a list of conditions, but I don't think it's like the commitment letter that you're talking about. There's essentially, you have to meet every single thing on that approval. And I think you guys had a great conversation about the contingencies piece, and on the loan side, it does take 25 days because of how much we have to disclose and the days that we have to disclose them in. I mean, if you were just to look at the compliance disclosures we have to send out, we really can't get going until day 7. So they've turned in all their stuff and we've made all of our disclosures, but we have these waiting periods that we legally have to abide by. So by day 7, we're really getting going, and that's when you're just ordering, you know, the appraisal's getting ordered because your disclosures are out.
But you're making risk gamblers out of us because we have to release loan contingencies without having a full, you know, approval in writing. So yeah, a lot of our people are sitting to a Gamblers Anonymous now.
I hope their treatment is effective. The industry at large is dispersing risk. I don't think it's what we want to do. We want to underwrite the loan, but at the end of the day, if we can't get it sold, either banks don't think it'll perform or something comes up, I think they're just being that much more cautious than they were prior to that time frame, and they didn't have as much default. Think about all the foreclosures that went through, the decline in property, all the short sales you guys are dealing with. I think that's what they're trying to avoid by not putting that stuff on the books.
Appreciate your honesty.
So generally, if a buyer does need a loan contingency, is it 25 days sort of the standard right now, or if there is a standard?
Yeah, but it can get pushed back pretty rapidly. So here's what happens is that any company has a certain number of underwriters. And for our company right now, we have about 35 underwriters, and we have probably 15 junior underwriters, which help on the condition side. So a precipitous drop in yield or rates will bring the refinance business flooding in the door, which, you know, we prioritize the purchase business to try to remain X number of hours. And I think most companies do because that's our lifeblood. When the refinance business goes away, if we don't have the purchase business, we're in a lot of trouble. So I would say right now with where the market is, because rates kind of ticked up a little bit, even though they've come back down, the refinances are pretty much done. I mean, we still have a little bit of that business. I would say 25 days is a good time right now. I don't think you can compress it much shorter than that, but they can definitely stretch out in a moment's notice of a bunch of business floods through the door. And I don't know, you guys can speak to this better than I can, but from what I'm hearing in California, Oregon, Washington, with the way the real estate market is going right now, lack of demand or lack of supply and fairly high demand, if there's any kind of demand that comes onto the market and a lot of deals come flooding in the door, you can see that expand. So it's something to definitely pay attention to.
One question, I mean, I know it's not so much a question, but sometimes frustration is the borrower that has the large down payment, 40, 50%, let's say, but can't qualify for the loan in those situations. Is it strictly just by the books? I mean, loan to value, debt to loan ratio?
Yeah, I mean, it's not very logical, right?
I'm sorry.
Yeah, so somebody has a tremendous amount of assets and they put a lot of money down, but they don't necessarily have a lot of papered income. And you're scratching your head going, this deal makes sense all day long. Your exposure to the collateral is minimal. They have lots of assets. They can pay the payment. But yeah, that's one of those situations where, because where all the liquidity is coming from right now, it's really kind of very linear and in the box. And if you don't paper qualify for the mortgage, when I say they, our regulators feel like that's what caused the downfall of the entire real estate market, was that we didn't document income, and that caused all these people to go into homes they couldn't afford, and they basically didn't look at any of the other variables that are the loans that actually did perform, which are, if I have a lot of assets and I'm putting a lot of money down, your exposure to the collateral is not that much. And I can make payments through other forms that maybe they're not documented because you don't accept it as a certain source of income. And they just threw that stuff out the window, you know, maybe with the bathwater type mentality. And we hope we're starting to actually see it come back. We're starting to see asset depletion products. We're starting to see some of the products that make sense. It's never going to go back to where it was. But if we can get some logic built back in there that says somebody that puts 30% down on a property has significant assets, but maybe they don't paper their income the way that they would like to see it on a tax return, I think we'll start to see that for particular borrowers only. Self-employed borrowers where it really makes sense, retired borrowers who have a lot of assets. I think you'll see that come back to the market. You're never going to see somebody who's in the workforce or the labor force. You'll never see us go back to those products. I shouldn't say never, but you won't see it for the memory's still pretty fresh.
Patrick, to follow on that, Ben Bernanke came out probably about, I saved the article, and I think I sent it out to everybody at least once or twice, that in his opinion, he was being interviewed, that he thought that mortgage lending standards were still a little too stringent. And then there was another Fed governor about 3 days ago that came out with the same thing. I don't know how long it's going to take that type of attitude to filter down to what we do. It sounds like at least their head's in the right place, and it sounds like, you know, the lifeblood of the economy right now is the housing market. The housing market is starting to kick off a regrowth in the economic recovery, and they want to keep it moving. They've done what they can do, which is push down interest rates, but when it comes to actual lending and letting that money out there, I think everybody in this room would agree and been through situations where it's still too tight, things don't make sense. There's a lot of self-employed borrowers, a lot of assets and things that were normally done because they made sense, and now in the new world they don't make sense.
Yeah, unfortunately, we're taking logic out of the equation.
Doug Frank, I hear there's 80 rules out, you got another 140 to go. I don't know anything about it. What's that mean?
So right now we're kind of in a waiting period because the regulator that's oversees Dodd-Frank, the CFPB, Consumer Financial Protection Bureau, they appointed a director. It was basically found to be unconstitutional, so we're trying to figure out if we have a director or not. So there's been a couple audits, so we have an idea. But the recess appointment of this director in January was found to be unconstitutional and at least elevated to the Supreme Court. So we're kind of unsure. We have comp plans, we have rules that are QM, qualified mortgage, QRN, qualified residential mortgage. So you're right, there's a bunch of rules that are come out. They're supposed to come out January 1st, 2014, but most of the rules are not written yet, not written clearly. So for us, there's still a lot of, we don't really know what's going on until probably this appointment is completed. The audits that they have done on lenders on the West Coast, they're not making public because they don't know if they'll stand up. If the person who was appointed as the director of the CFPB is completely removed from the CFPB, those audits will go bye-bye, and they'll probably have to start the process over. I think the one that is probably will be somewhat affecting, especially in your guys' market, is the qualified mortgage rule. The qualified mortgage rule is out, and the biggest part of that rule is the borrower's ability to repay. And so they've capped the borrower's ability to pay at 43% of DTI. So those are for non-agency loans. So if you're doing a jumbo loan, it doesn't matter who you are, you're not going to be able to exceed 43% debt to income ratio. So that is the one rule that we know will go into effect. And how it plays out or how it changes between now and then, there's still room for changing it. But I think that's the one where we used to be able to have investors make their own decisions, right? So I could go to 45, or I had a lot of assets, so that compensating factor will allow me to go to 47% debt to income. That probably goes away in January 2014. There'll be a hard cut at 43%. There's still a lot to be untangled in the qualified residential rule, which is the capital retention one, which could be really harmful to the mortgage industry because it would require companies to hold 5% of their capital on any non-agency deals. And if you type 5% of any company's capital, even if you're a big bank, they're going to become even more risk averse because they're putting a whole ton of skin in the game. So those are the two rules that will probably have some sort of impact as it relates to the real estate biz. The rest of it pretty much all in play. So the compliance for disclosures, the compliance for appraisals, the compliance for comp, it's in play. There may just be some little tiny tweaks to that. Cool. Thank you guys. I appreciate it.
Thank you.
Thank you, Patrick.